Hello. Usually people have a tendency that comparing their FD investment with equity investment. I have seen an investor who has put their money, deposited their money in mutual fund. At the same time, they have deposited that money in FD also. And this person, she didn't have much of the knowledge about equity market, but even then she wanted to look this as an opportunity to invest and see that how it will work. But this is a case study how during the time of investment, how she has kind of reacted to the market changes and she have taken out the money. But the each dates, how the market fluctuation happened, I'm going to talk about it. But when you really compare any kind of asset classes, you can't really compare because the nature of the investments are totally different. So the case situation is something like this. The investor has deposited money on September 20th, 2019, 6 lakh rupees each in mutual fund, equity and usual bank FD in a nationalized bank. They have deposited the money. And this money deposited by the time of July 30th, bank FD has reached about 6,21,000 rupees. Got about 4.5% of interest in 284 days. The moment they have got 21,000 rupees as an interest, they compared this instrument with mutual fund equity and saw that the return was nothing, only 6 lakh rupees, whatever money they have deposited, same it was. And that time they have checked with various people, they have checked with their own parents and everyone and understood that bank FD is much better. Going for this kind of equity investment is risky and not getting much of the benefit. And they have asked for a redemption. But this investment in mutual fund, it has not reached 1 year. If any mutual fund instrument, especially in equity when you invest, if that investment is not reaching 1 year time, they will have an exit load of 1%. And they have communicated, but they were very persistent and decided that they have to withdraw that money or redeem that money. And when they have redeemed 6 lakh rupees, they have got about 5 lakh 92,000 rupees. It's about 7,500 rupees as a loss they have booked, and they have decided to deposit that money in FD. But now if you look at it, if that investor didn't take any action, she would have kept that money as it is. That mutual fund investment in equity keep as it is half and FD keep as it is half. This money would have, this mutual fund investment 6 lakh rupees, because thanks to the market growth, this money has grown to the kind of fund they have invested was an aggressive fund, because this before investing, the goal of investing was for the kids' education. Kids' current age is 2 years and they have about 15 plus years. So when you have 15 plus of years, investing in equity mutual fund is always good. Don't expect in two years time you will get a very good return, but even then over a period of time, 5 years, 7 years time, you will able to get almost double of your FD return. But thankfully market was good from 2020 to 2021. After 1 year's time, if you look at this scheme, it has grown to from 6 lakh to it grown to 10 lakh rupees. So which means close to 5 lakh rupees profit has come. But then they have moved to this one, this 6 lakh. I'm not talking about 12 lakh, but this 6 lakh, it's only grown to from 6 lakh 21 to only 6.5 lakh. So here they got this 6 lakh rupees, they got 50,000 as a profit, and here they should have got about 4.87 lakh rupees. This is the difference between investing in equity and debt. It's not really good to compare with equity and debt. And when you come to invest in equity, There are times your price, whatever time. So for example, this is the return and this is the rate or a growth you are expecting. So when you investing in debt, it will grow like this, almost very disciplined on a normal growth you will get. But when you invest in equity, there are chances that it can go in the same way. There are chances that it can come to the negative also. But over a period of time, it will pick up and it will give a growth on a long run. If you have a time, let's say that like in this case, the goal was for a kid's education, around 15 years plus is there. So if your goal is, let's say that 5 to 7 years or more than that, always look that one portion of your investment, you can definitely look into equity. This is not a recommendation that you should choose equity, but this is a return perspective you have. So if you understand how this instrument work, and with the help of an advisor, if you can take the instruments in a right way and you choose the right product selection, it is always good to gain a better return than normal bank FD. So this is a real case study. Because of panicky, they have withdrawn. Thankfully, they didn't come in the month of March. If they would have come in the month of March, this money has gone negative. But when they came at the time of July, at least this money has almost leveled. From there, market has picked up, and in another 1 year's time, it has given almost double the profit. Don't really expect this return always from the market, but on a long run, if you have time, let's say 5, 10, again telling that 5 to 7 years time, always keep a diversification, some amount in equity, some amount in debt. I hope this case study will throw some lights in terms of choosing your investment, especially you have a time of a long period of time. Even for a short period of time also, you should able to allocate your fund accordingly. That will ensure that you will able to get decent amount of return from your portfolio. I hope this will throw some light on choosing the right instrument, especially when you have a bulk amount, let's say 5 lakh or 3 lakh or maybe 10 lakh plus. It is always good you are allocating your investment vehicle or investment products such a way that you will protect your risk, and at the same time you will able to get return better than your usual FD instruments. Thank you. If you have any questions related to this content, you can write to us or call us during the work hours. We will respond back. Thank you.